So this panel is about something that is particularly popular these days. Today in the Financial Times, there were 2 articles on stable coins and CBDC and payments. So when I started to work on payments, I thought that was a very boring subject, and nobody cared except when they do not work, as the colleague in Germany have experienced last week. I guess the client of a famous payment system had several problems last week in Germany. So we are talking about something very, very serious. We are at the crossroad of 3 major changes, I think. Technology, thinking about issue about strategic autonomy in Europe, and fragmentation. First, fragmentation on the trade level that soon or later will have an influence also on international monetary system and payments. So at the ECB, we are taking very seriously this problem, and we have been thinking what to do for a while now. And briefly, we are working on 3 dimensions, which will be part of the discussion today. One is making the internal market for payments work better. And we think that the digital euro will be instrumental to that. Along with private initiative, we think that the digital euro will help to make some way to provide a unified system in Europe, but also help the private sector to develop on the rail of digital euro a solution that finally could unify the payment system in Europe at the retail level. The second leg to strengthen the internal market is what we are doing on the wholesale level. We know the market is interested in experimenting with the new technology, DLTs, on trading asset or issuing asset on DLT. The question is how the central bank can support this process, or at least avoid to be an impediment to this process. And the key point is, how do you provide liquidity to those that wants to trade asset on DLT? So we have been reflecting on that. Last year in 2024, we ran a long experiment on trying to provide liquidity to those that wanted to trade asset on DLT. The reason why the market want to experiment that is pretty obvious. They expect that they will gain efficiency because the 3 traditional steps of trading an asset, the issuance, the custodian, and the settlement and the custodian, today rely on 3 different infrastructure. Tomorrow they could rely on 1 single infrastructure. So there is efficiency gain to be gained. We think that, again, if the central bank will not step in this market, somebody else will do, for example, stable coins. And we would go back to the problem when credit risk was associated to trading asset. So we want to do something, and we just launched these 2 important projects. One is called Pontes, and another one is called Appia, to see how in the future the central bank can provide liquidity in an efficient way. The third point, the third area on which we are working is on cross-border payments. The ECB has been supporting the G20 agenda on cross-border payments for a while now. And we think that a key possible solution would be rely on fast payment system. There are a number of fast payment systems around the world. I don't know the exact number, but we are talking about maybe 70 jurisdictions that have fast payment system, plus more than 80 plus. So it's a smart idea to try to leverage on that and try to link on that. That's what we are doing at the ECB. We are doing in a different way, but this is not the occasion to dwell on this, but we are working on different models. And you might know that, for example, the fast payment system in Denmark now moved on TIPS, which is the fast payment system of the Euro system. So we are doing it in a number of ways. However, all we are doing has a policy dimension, a technological dimension, but there are very serious problems when we go and talk about the legal dimension of it. Especially for interlinking fast payment system, the real hurdle is not technology, but it's the regulatory and the legal dimension to it. That's why this panel is central to what the ECB is doing, and I'm glad that we have 3 major experts on this field. So let me thank Ruth, Desi, and Professor Douglas for being with us today. So the rule of the game is the following. You guys will have 15 minutes each, and then we will have I will open for a Q&A session. I guess we will start with Ruth, and she will give us a wide range discussion on the resilience and autonomy building in the European context. Please, Ruth, the floor is yours.
Thank you very much. And thank you so much to Chiara and the whole ECB for this kind invitation today. And thank you for bringing up the slides. So I'm in payments since 2003, which means I have had very exciting times, because since that time, we built systems and harmonized the European market around the Eurozone quite significantly. And my presentation will go into a little bit of these origins of how we created harmonization, built the systems, where we are with this effort at this point in time, and what new challenges, as you just outlined, Piero, are coming upon us around technology, but also increasingly, of course, geopolitics, which is the big theme that we have been discussing today. So if we zoom back to 1999, we introduced the euro, and people realized that we had domestic payment systems in all of those countries that now have the euro. I mean, by now it's 19 member states, which is, of course, a significant number compared to those days. And the effort was really to harmonize those systems, to create maybe something like a 28th regime, but it was harmonization really of rules and allowing systems to compete across the market based on those same rules. So it was all about removing the fragmentation and strengthening the European single market, because the flow of money, the flow of value in a trade union and in a monetary union is, of course, the critical lifeblood that sustains the whole economy. So from that perspective, we went ahead and developed the single euro payments area. And I was involved from day one. Since 2003, I wrote one of the rule books for credit transfers. That probably makes me a total nerd as well. But at the same time, and just to remind everybody, we were the first jurisdiction at that scale to introduce ISO 20022 as a global standard, which has since then been adopted by many jurisdictions, even by SWIFT in a global rollout. And of course, your interlinking of the instant payment schemes, which we will talk in a minute about, is also based on harmonizing those messaging standards for the value flow between participants. SEPA now has delivered significant amounts. Everybody that is using euro in the European Union, so it goes, of course, far beyond just the Eurozone. It covers the whole EU and EEA member states, is using SEPA. We now have 31 billion credit transfers alone in 2024. A lot of them, the criticality of the European Central Bank here is really the settlement system. What we had for many years was clearing system at an industry level with EBA clearing. But of course, the change of ownership of funds is critical. The settlement finality directive as the underlying legal basis is critical. And more markets are flowing. I mean, every SEPA transaction ultimately flows into a TIP settlement if it's a single one-off transaction. Again, of course, open banking comes on the back of SEPA, because SEPA was sustained by the Payment Services Directive. a law I negotiated from 2003 to 2007. It was probably one of the longest negotiations. Later on, these laws were negotiated a lot faster. But the PSD1, the Payment Service Directive, again, was the first of its kind to provide harmonized technical and conduct of business and consumer protection rules, plus a licensing regime for non-banks in such a large market. And again, it's a law that has been copied by many other jurisdictions, including countries as random as Japan. So these were foundational pieces to harmonize how transactions flow, how customers and consumers are protected. And this has delivered incredible benefits in terms of efficiency. It has allowed the introduction of non-bank players into the market. We saw this evolve with the second Payment Services Directive in 2018. And even though the UK had the faster payment system first in 2008, we have had SEPA instant transactions since 2018. And we have now this year a legislation in force at European level that mandates SEPA instant transactions, which is exactly where we can now accelerate all these other initiatives in terms of a digital connected economy in real-time payments. Open banking, as I mentioned, is built on these instant payment transactions. It is really critical, and it's all about allowing data to play a more critical role. The ISO standard allows a lot more information in the payment message. And if we move from a payments use case into an open data use case with digital identity, with the ability of consumers and citizens to have a broad choice of financial instruments by banks and non-banks that are legislated and licensed, then of course you're suddenly opening up a whole competition agenda of finance services at a very, very large scale. However, and I have to add this here because we heard so many articles this morning, right now we are in the last strides of negotiating the third Payment Services Directive, which comes together with the Payment Services Regulation, something that I've asked for more than 10 years because we need that level of harmonization, particularly as it pertains to the conduct rules of how the different players should act and what standards they are held up against to. And here, the role of third-party payment providers that had been introduced by PSD2 is still disfavored in the sense that PSD2 brought in non-bank players to allow these API connections of data flows between banks and consumers to allow for more choice. And until now, 75% of the bank APIs are not adequate and 33% are not working. The European Commission, interestingly, has been really on the side of the innovators and those third-party non-banks to push for better standards and fulfillment. And we saw the Council that suddenly struck out a number of relevant articles or modifications. So I don't know what's going on there. I don't think this has to do with member state autonomy. This is maybe more of a dimension between banks and non-banks that are still not working together to create that competitive outcome that is so critical for the single market and for the fintech market, because we want to have growth of fintechs in the European Union. And what we see is that this is still hampered significantly by some of those imperfections. So we are very much relying on the last elements of negotiation to bring back articles that were there to remove the obstacles that were introduced and delivered by PSD2. Enough of that. We have now 80 plus instant payment systems worldwide, which is where that interlinking agenda makes a lot of sense. And as a third point, just to add it here, when it comes to autonomy, and I remember the last 20 years, we always strive for autonomy from the American card schemes, for example, Visa, MasterCard, American Express, and Diners. And there were for many decades now attempts to build a European card scheme. Now everything has moved into APIs, QR codes, and digital wallets. So cards, in a way, are no longer that relevant. We do see that even the card schemes themselves have significantly invested in the ACH, the automated clearinghouse space, to allow for competitiveness in those payment flows and interlinking. And I'm happy to say that the alternative is really the open banking payment flow between users that have bank accounts that use a digital wallet in the middle. And the European Payment Initiative has launched the Wero digital wallet in this year and already has significant traction. It's only operative at the moment in Germany, France, and Belgium, but I would say it's the first notable success after decades of failed attempts to recreate a card scheme that is no longer that relevant in my view. So the challenge that remains is competitiveness more between the types of providers at European level. We heard earlier on that sometimes we're shooting ourselves in the foot when it comes to the internal market, when it comes to the levels of tax within the internal market, how costly it is to exchange goods. We mentioned 45% versus 15% in the US. And I would argue that having more competitiveness and enabling legislation in the space to allow for more competition and choice, given the significant consumer protection we have, is certainly the remainder to deliver at this stage. Now, let's get to the next big topic, the central bank. I'm happy to report that in 2017, I delivered one of my pre-PhD papers, which was a framework for a digital euro to the annual ECB conference in Italy, held in Banca d'Italia at the time. And frankly, it was such a success that I was quoted by the Central Bank of Norway and other central banks. Again, a nerd comment on my side. Everybody got really excited about the opportunity of using technology to create a digital central bank money version. And as I argued at the time, have elements of programmability, maybe to comply more automatically with anti-money laundering and other provisions that are very challenging for the industry. Now, of course, the role of the European Central Bank as a guardian of our financial system and integrity is absolutely central. And here I coined the term in the conversations I had with the team prior to this conference. We are now looking at not only lender of last resort, but also infrastructure of last resort. Whilst I would say that initially those ideas of a digital central bank currency were very much motivated by the arrival of Bitcoin. I remember Lagarde's speeches at the time when she was the head of the IMF, by the fact that we had Libra and we had a private ecosystem that was going to suddenly crowd out central bank money and do things behind our backs. But now the situation has again changed. It moved into the innovation agenda for a little bit. Should we not also innovate as a central bank and have an alternative to all these other digital opportunities out there, mostly private? But I think now we suddenly have this dimension of autonomy, because we are in a very different geopolitical situation, which is why infrastructure of last resort is probably a good term. This is not there to crowd out the banks. Of course, you can imagine, I mean, I worked many, many decades with banks and even for a bank. The banks were very well worried about narrow banking. Naturally, everybody goes into a central bank asset and moves out all their deposits. Is the lending going to come back through central bank lending back to the banks? Will it get more complicated? The other argument, of course, is do we need a retail CBDC because we have so many digital payment solutions already that work very well? And financial inclusion is always a topic of two minds, so I'm not going to go into any detail there. But certainly, I think the narrative now is it is an infrastructure of last resort. It is a backup, but also something that you may use more as times may change. I think it's about flexibility and having infrastructure in place that is secure and resilient. Therefore, the big topics that are still there are, of course, the topic of privacy. I've both advised the ECB and the Bank of England, particularly on privacy in the Bank of England context, because some citizens are concerned that it becomes a monitoring tool. And so I think privacy has to be approached from other legislative angles, such as GDPR, which actually is not enforced very well. It's also not written very well. So maybe that's on the to-do list for another time. There are other discussions around economic models for wallet providers. How do we finance the ecosystem and make it viable? And then, of course, the big elephant in the room is cybersecurity. Cyber risk of any type of infrastructure has gone up through the roof since AI arrived. Every system is at risk. I work for a cybersecurity company at this point in time, and we can see the risk exposure of businesses, banks, central banks, anything. We can visualize it, and we can actually see what type of risks are coming towards you and how they're already sitting in your systems. And this is something where most of the industry has a blind eye, but it has become the biggest risk of our time. Therefore, building a central bank digital currency with cyber resilience at the core is critical, and it is the competitive advantage. If we get it wrong, the trust will be lost in the solution. So I would just say that in terms of a warning, but also in terms of something that is, of course, being looked at. Wholesale CBDC is a different story altogether. I think this has maybe to a certain extent advanced a bit more slowly, because here the opportunity is to collapse infrastructures islands that are highly regulated, CCPs, CSDs, registrars, into one ledger infrastructure. This has to do with member states that in some cases run these infrastructures that may not want to collapse those. It has a lot of vested interest potential, but it has a lot of efficiency potential if executed correctly. Again, on both accounts, I would say distributed ledger technology in a more decentralized implementation would be critical, because anything that's centralized is, again, a central cybersecurity attack vector that makes it so much easier to compromise. And I wrote a whole book about re-decentralization in case anybody's interested, because I think this is another place of our time that things have become too centralized. So, reinforcing, not competing. We talked about this already in the open banking context, but here it's about, again, building an approach that is public and private collaboration, complementary. It is innovative. Again, the narrative has shifted. There's no intention of a central bank to compete with the private markets. But of course, we are looking at a different value chain. Roles in the system may change. Certainly, the roles of commercial banks could be reduced a tiny bit if a lot of individuals go into central bank digital assets, into CBDCs. We will have new players with wallet providers. I think this is a very important debate because wallet providers today, the biggest ones are American, Apple and Google. The question, therefore, would we allow a digital euro in an Apple or Google wallet? Or would we allow it only in European approved institutions that offer wallets? How will they be commercially viable? What can they charge? And how do we actually link it more with the European Identity Wallet, which is a critical initiative that is now coming to life in the next few months and years? It's something that the UK market is unfortunately missing still. If you do not have a viable and resilient digital identity proposition and potentially a competitive market around that proposition, you cannot operate an efficient digital economy. And so this is a critical ingredient that's a baseline from that perspective. Strategic vision, of course, is to prevent duplication and maximize synergies. And you already mentioned the two projects, Pontus Pilot, which is happening now on the wholesale DLT platform, and then the future that will bring us hopefully into a whole different financial ecosystem, which again will have very different business lineups, different business rules, and very different players. So the financial industry at large may look really different to what it is today. And I think it's important to think outside the box to see what that could look like. Now, views on stablecoins. I have to say, when I teach at university, which I do sometimes for fun, and please note that these are all my own views and have nothing to do with Base Business School, which used to be called Cass Business School, just for those that may remember that. The reality is that to a certain extent, it's emperor's new clothes, because of course, when we think about our 2001 e-money legislation, our e-money directive in Europe, we already had the principles of e-money, which really should have been and are in a way technology agnostic. So stablecoin is using a different technology, but it's still the same idea. You give a stablecoin issuer fiat currency of some form, hopefully in digital format, and they will issue a stablecoin that runs on a different technological infrastructure, and you can do things with it the way you like. It came, of course, from the fact that we have too much volatility in cryptocurrencies such as Bitcoin, because they were speculative instruments rather than payment instruments. Now, if I just remind everybody right now, the way stablecoins are used is primarily for illicit activities. Certainly more than 63% roughly in the market are used deliberately for sanctions, breaches, and money laundering rather than anti-money laundering. So there's a significant governance risk embedded here, because not all of these providers that issue those types of instruments are legislated and regulated, and certainly not necessarily supervised. And I think the supervision we mentioned several times today is always the Achilles heel. If there's no good supervision, it doesn't matter what rules you've got in place, they're clearly not working. Now, of course, for the US, it's a gift given from heaven, because most of the stable coins are US dollar denominated. And that's why our lovely president over there has now approved the Genius Act, which is basically just an e-money legislation with a few cyber components to it. So it's not very different to our MiCA legislation we have in Europe already for several years. It's almost like getting on par with it. But it's certainly there to further encourage the spread of US dollar stablecoins. So it's all about US dollar hegemony in a certain way as well. And it's a way to finance the 37 trillion debt that is currently in place. And I'd be very interested to hear what Douglas has to say later on around alternative initiatives, because certain parts of the world are trying to move away from US dollar dominance, including in the currency space of crypto. Why the shortfall of European resilience sovereign objectives? Of course, very clearly, supervision and regulation is not the same. In fact, some of them are not really supervised at all. They're private entities. There's risk of fragmentation, particularly as you go into different currencies and different providers, and also the jurisdiction they're located in. It's not a way for us to reduce a dependency on other means. And of course, systemic risk and stress is critical. We have different types of stable coins, which we've seen completely melting down with algorithmic stable coins. So there's a lot of experimentation going on. And again, I would say stablecoins are centralized entities issued by an entity. They're not run on decentralized ledgers in certain cases, and therefore there's a significant cybersecurity and, of course, significant fraud risk, which we've already experienced in terms of the last few years. Now, I see I'm overrunning, so I'm going to finish with cross-border payments, which are the most exciting part. And of course, we have Desi talking about those in more detail. But cross-border payments, particularly wholesale, are still slow and expensive. We only rely on correspondent banking at this point. It is quite frightful to see how global treasures of businesses are being lured into the stablecoin narrative as a tool for making institutional cross-border payments. This is today not really feasible under bank liquidity rules, under accounting rules and other rules. So there's a lot that has to happen to make this a viable environment. And frankly, by that time, we may have cross-border interlinking or cross-border CBDC interoperability already in place. Remittances, again, is another area where stablecoins do not really help, because financial education isn't sufficient, availabilities of smartphones and network isn't sufficient, and therefore stablecoins are not the answer to that either. And clearly, we are looking at interoperability of faster payment systems around the world, as much as interoperability in the wholesale side. And I think that is going to be the more critical one, because it's about making high-value cross-border transactions for international trade more efficient. It's all part of the G20 mandate that is being executed. I already mentioned ISO 20022, harmonization of AML laws, access to safe settlement currencies, and of course, all of that with the innovation we have in mind. So let me just close on the last point, because we have it in our outline. Cyber resilience and operational resilience is that one piece that is absolutely the Achilles heel of any system and any initiative. We have incredible laws with DORA in Europe, but we have incredible challenges of supervising them and ensuring that businesses are adhering to it. I have conversations with supervisors on these topics when it comes to the cyber side. And I would say that anything we do going forward has to have full cyber and operational resilience, because otherwise lack of trust, loss of trust will happen as a consequence far too quickly. Thank you.
Thank you, Ruth. You went through a lot of material, and I'm sure that there will be an interesting discussion on many of the things you said. Now, let me turn to Desi. So Desi, this is the General Counsel of the BIS, so she can give us the perspective of an international organization who is trying to put together several central banks and let them work together on this difficult point. Please, Desi.
Thank you very much, Piero, and thank you very much to Chiara and the ECB for organizing this conference and for inviting me and giving me the opportunity to tell you a little bit about the work that the Bank for International Settlements does in the field of cross-border payment systems. The technological developments in the last years have accelerated the pace of innovation in payment systems, and have created opportunities for improvements to address the main challenges that affect cross-border payments today, which are high cost, low speed, poor transparency, and limited access. However, these opportunities have also come with the challenge of how to harness technological innovation while continuing to ensure robust and safe payment infrastructures, something to which Ruth has referred, and which is indeed instrumental for retaining public trust in the systems and also for maintaining financial stability as a result of that. There are also challenges of reconciling the benefits of technological innovation with considerations of payment or monetary sovereignty, which are some of the points that were raised in some of the presentations earlier today, and even in some cases, national security. So I think, Piero, as you said, while technological solutions for interlinking national instant payment systems or establishing a common unified cross-border payment platform have been identified, one of the biggest barriers is in fact not the technology, but it is rather that in order to apply these technologies for enhancing cross-border payment systems, we must first overcome or somehow address the divergence of legal and regulatory frameworks across jurisdictions. And we were talking in the morning about the difficulties for this kind of harmonization within the EU, but you can only imagine how exponentially bigger that problem is when you go across different countries which are not part of a common union. So therefore, international collaboration for harmonization or reconciliation, if harmonization is not the best way, of legal and regulatory frameworks is key for yielding the economic benefits, which are undeniable, of enhanced cross-border payment systems, which modern technology can actually already enable. I would like to tell you today a little bit in particular about one BIS project which has successfully proven the possibility for multilateral interlinking of cross-border payment systems. And I have chosen this project because actually it has now been handed over for real-world implementation. But before I go into more detail about the project, which is called Project Nexus, and Douglas will also talk a little bit more about that, I would like to give you some more general background on the evolution of some of the work of the BIS in the field of cross-border payment systems and infrastructures, for those that may not be so familiar with it. And even those lawyers that do work in the field of international monetary law may also not be very familiar with this area of our work because I think, again, Piero, you said it wasn't really a very interesting topic until probably the last 5-10 years. And in fact, it was often referred to as the plumbing of the financial system. So it wasn't something lawyers or even economists really wanted to go into.
It's bad when it goes wrong.
So the work of the BIS in the field of payment system actually dates back to 1980 with the establishment by the governors of the then central banks of the group of 10 countries. They established the group of experts on payment systems. The purpose of the group was to monitor and analyze the payment system developments, to promote safety and efficiency of payment, clearing, and settlement arrangements, and analyze policy issues related to cross-border payments. They were very much focused, however, on the issues related to their 10 economies. In 1989, the G10 governors set up the Ad Hoc Committee on Interbank Netting Schemes to study in more detail issues related to cross-border and multi-currency interbank netting schemes. Its report, published in 1990, contains a set, or the first set, I would say, of minimum standards for the operation of bilateral and multilateral cross-border and multi-currency netting schemes, and sets out the G10 central banks' framework for the cooperative oversight of such systems. In the same year, the G10 governors also established the Committee on Payments and Settlement Systems as a follow-up to the work of the Ad Hoc Committee on Interbank Netting Schemes, and more generally to take over and extend the activities of the group of experts on payment systems. This committee, or the CPSS, was set up as one of the permanent central bank committees of the BIS and reporting to the G10 governors. In the period 1997 to 2009, the membership of the CPSS expanded to include 25 central banks and started to report to the governors of the Global Economic Meeting of the BIS to reflect the expanded membership. In light of the evolution of its activities, a new mandate for this committee was approved by the Global Economic Meeting as of September 2014, and the committee was renamed to the Committee on Payments and Market Infrastructures, which is the name that it carries today, and which currently comprises officials from 28 central banks. The mandate of the CPMI is to promote the safety and efficiency of payment, clearing, settlement, and related arrangements, thereby supporting financial stability and the wider economy. The CPMI monitors and analyzes developments in these arrangements, both within and across jurisdictions. It serves as a forum for central bank cooperation and related oversight, policy, and operational matters, including the provision of central bank services. And while the CPMI does not possess a legal personality or any formal supranational authority and relies solely and entirely on commitment of its members to carry out its mandate, it has established itself as a global standard setter in this area. The CPMI cooperates closely with other standard-setting bodies, such as the International Organization of Securities Commissions, IOSCO, the Basel Committee on Banking Supervision, and with the Financial Stability Board. Jointly with IOSCO, the CPMI has developed, fosters, and monitors and carries out regular evaluations on implementation of the principles for financial market infrastructures and publishes a number of guidances and recommendations for risk management of financial market infrastructures. And in fact, it has just recently carried out such an evaluation of the implementation of the principles by the EU. In addition to the work of the CPMI in the field of risk management of financial market infrastructure, which includes work on cyber and operational resilience of FMIs, and the CPMI also has an extensive guidance in this area. Enhancement of cross-border payment systems is a key priority of the work program of the CPMI, and this is the topic I will focus a little bit more on today. I'd like to tell you a little bit about the BIS Innovation Hub, because the next generation of FMIs, with a particular focus on enhancing cross-border payments, is also one of the core themes of the work of the BIS Innovation Hub. The BIS Innovation Hub was established in 2019 as a unit within the BIS, and it was created with the aim of fostering international collaboration on innovative financial technology within the central banking community. Part of the mandate of the BIS is to develop public goods in the technology space geared towards improving the functioning of the global financial system. All of the BIS Innovation Hub projects are experimental in nature. Now, how do these two strands of the work of the BIS, the standard setting and the Innovation Hub, come together? The BIS Innovation Hub experimental work complements the guidance provided by standard setting bodies by investigating the feasibility of new technologies for addressing, among others, for example, the challenges for establishing efficient, robust, and safe cross-border payment system. The BIS Innovation Hub projects also provide practical insights into the implications of new technologies, which in turn can inform the work of the standard setting bodies, supporting the development of harmonized standards for emerging financial technologies, and in turn would facilitate their adoption with the aim of improving the global financial system. Now, against this background, let me turn now to the project I mentioned and the recent BIS initiatives in this field and how they aim to address the legal and regulatory challenges that we have referred to. Indeed, Ruth mentioned that the G20 has prioritized enhancing cross-border payments to achieve faster, cheaper, more transparent, and more inclusive cross-border payments while maintaining their safety and security. And in 2020, approved the G20 roadmap for enhancing cross-border payments, which was developed by the CPMI and the Financial Stability Board and other standard setters, and which sets specific goals for achievement by the end of 2027 for improvement across the key 4 dimensions: cost, speed, access, and transparency. The first 2 years of the roadmap were very much about exchanging experience and stock taking, and also identifying the key issues that need to be addressed. In October 2022, a prioritization plan and engagement model for taking the roadmap forward was developed and was published. And the roadmap, and it reflected that the roadmap had reached an inflection point and needed to move to implementation of practical projects to enhance the cross-border payment arrangements in order to be able to achieve the quantitative targets by 2027. So it specified a number of specific actions, but one of the specific actions that were to be undertaken as part of the main themes of the roadmap was the completion of the BIS innovation project Nexus. The objective of Nexus is exploring the interlinking of instant payment systems and related governance, risk management, and oversight considerations. It is a project carried out by the BIS Innovation Hub in collaboration with the central banks and payment system operators of Indonesia, Malaysia, Singapore, the Philippines, and Thailand. In 2022, working with the Central Bank of Italy, Central Bank of Malaysia, Monetary Authority of Singapore, Banking Computer Services in Singapore, and PayNet in Malaysia, the Nexus team built a working prototype to connect the test versions of 3 established instant payment systems, those of the Euro system, Malaysia, and Singapore. This is also one of the reasons that I have chosen to talk about Nexus, due to this successful proof of concept, which confirmed the technical viability of the Nexus, in which involved the interlinking of the payment system of the Euro system. So following this experimentation, in 23-24, the Nexus team worked closely with the central banks of the Asian 5 countries, which have confirmed their interest in using the Nexus blueprint as a framework to achieve their public commitment to interlink their domestic instant payment systems. The team tested the model against the reality of these payment systems, but also consulted with central banks, standard setting bodies, IPS operators, and commercial banks across the world to validate that Nexus is scalable and interoperable with IPSs beyond these 5 countries. Nexus eases IPS interlinking by standardizing the way that IPSs connect to each other. It consists of a payment scheme supported by software, which is called the Nexus Gateways, and which allows IPSs to communicate using application programming interfaces and ISO 20022 messages. In essence, instead of each IPS building bespoke link to every other, which is the model which exists in some systems across the world for bilateral interlinking, Nexus provides a standardized bridge platform. Each IPS has to connect only once to Nexus and can reach all other participating systems. As a result, Nexus facilitates cross-border payments for individuals and businesses holding accounts with banks or non-bank payment system providers in their countries, and which providers are eligible to join their domestic IPS. Unlike a typical domestic IPS, however, Nexus does not maintain a ledger of balances or obligations between financial institutions and does not hold funds or accounts for payment service providers. National IPSs are designed for domestic use, and their rule books typically do not address legal issues arising in cross-border payments, which is one of the main challenges. For example, in the event of failed payments or other problems arising, the dispute resolution process is governed by the IPS's rules and the applicable legal system within which the payment is executed. With cross-border payments, understandably, legal risks are heightened due to potential conflicts between the laws governing the transactions, activities, and participants in the different jurisdictions. Differences may include settlement finality regimes, access rules, limits on foreign investments and residents' currency holdings, data protection and privacy, fraud protection, prevention, AML, CTF, and sanction screening requirements. Nexus overcomes these challenges by being designed to be complied with domestic regulatory requirements and to respect each country's domestic monetary and financial stability policies. It provides a robust governance solution to address potential discrepancies on issues such as payment finality, AML, CTF, and sanction screening rules, treatment of fraudulent transactions, and rectification of errors, as well as regulatory reporting requirements. The experimentation phases of Nexus have proved its viability, and in April 2025, the participating central banks established the Nexus Global Payments, which is a company limited by guarantee incorporated in Singapore to operationalize Nexus in the real world for facilitating cross-border payments between them. And Douglas is going to tell you a little bit more about the Nexus Global Payments company. It will be responsible for the overall governance and management of the Nexus scheme and for producing and managing the Nexus rulebook. The rulebook will define the eligibility requirement, rights, and obligations of participants in the scheme and will describe the processes, rules, technical standards that govern how payments are made. The rulebook, importantly, will not override, but it will complement domestic scheme rulebooks. So I can tell you quite a lot about how this is going to work in practice, but I will leave this to Douglas, and I can supplement in the interest of time as necessary. Also, if there are any questions. But before I hand over, just to summarize that cross-border payments are inherently more complex than domestic payments, and they do require quite considerable coordination between payment service providers and payment systems in different countries who indeed do have to do a number of additional steps related to currency conversions and have to reconcile regulatory requirements in the different jurisdictions. I want to mention here that it could be argued, even though I did select to talk about Nexus as opposed to some of the other BIS Innovation Hub projects, it could be argued that multilateral interlinking arrangements do not necessarily provide the level of efficiency gains which a common platform model could potentially provide. And this is the model being explored, and I'll just mention it for you, and you can look that up on our webpage, explored by another BIS innovation project, which is called the Project Agora, which is currently in progress of development and implementation. And one could say that that project is much more ambitious than Nexus, because it actually explores a vision for a future monetary system, which aims to capture the potential benefits of tokenization for payments, clearing, and settlement through a new type altogether of a financial market infrastructure, which is called the unified ledger. But that is a topic for another presentation. What, however, should not be understated is that Nexus has nevertheless shown that through international collaboration and by using modern payment technology, adopting international payment messaging standards and building on already existing domestic IPSs, it is possible to make the experience of cross-border payments almost as smooth and efficient as domestic payments. Nexus provides effective mechanisms for oversight, for managing financial and operational spillover risks and dispute resolutions, and can preserve monetary and payment sovereignty. It presents a viable solution for improving cross-border payments, and with continued international collaboration can be further scaled and expanded. Thank you very much for your attention.
Thanks very much. And first, thanks to Chiara and the team for the invitation to be here. And thanks to Ruth and Desi for an excellent start. It actually means that I can cover just a number of specific things in my presentation, which will hopefully enable us to get to some discussion at the end. I really want to kind of hit 5 points. The first is really what I'm looking at is this fact that it's not only Europe that is looking at these issues around autonomy. In other words, we're seeing a variety of other significant jurisdictions that are pursuing similar objectives in the context of the intersection of money, finance, and technology. The second point is really this idea that I think is something that we've all seen, but it's core to a piece of work from my frequent co-authors, Ross Buckley at the University of New South Wales and Dirk Zetsche at the University of Luxembourg. Essentially the idea that if we look at the long period of human history, finance, technology, institutional frameworks have always been co-developmental. In other words, take something like a coin. A coin brings together technology, that's metallurgy. At the early stages of human civilization, amongst the very first things we see are rules of accounting. That brings with it writing. These are institutional frameworks. Now, what we've seen, and I think particularly Ruth's presentation has highlighted this very well, is that I would say over the past 40 or 50 years, we have seen an acceleration in technological changes. Now, those technological changes, as have and probably always will be the case, are rapidly brought into the context of finance. Now, law, regulation, institutional structures tend to lag a little bit, but there is always a process whereby those systems catch up with developments. Eventually, we see a change in, say, technological horizons. That means that we need a change in legal and institutional frameworks. Now, the last piece that is really the subject of a lot of my current work is also adding in questions around geopolitics. In other words, that we can think not only of this co-development between finance, technology, and legal and institutional structures, but throughout most of human history, there's been a fair amount of competition amongst different models of financing between states. And there's a fair amount of political science literature that suggests that in any competition or conflict between two states, the state with the larger economy and the better financial system over an extended period of time will usually come out on top. And this is something that we've had this situation probably since around 1989, where geopolitics have been unusually submerged in the context of economic and financial relations. And I think something we're seeing is that paradigm, which most of us have spent most of our lives within, seems to be changing rather rapidly. And the end result is that we are seeing a number of areas where this particular combination of technological horizons, institutional frameworks, and geopolitics are coming together. And in many cases, they're areas where we've been talking about for an extended period of time. Cross-border payments. We've been talking about issues with cross-border payment systems for quite literally decades. But we're at an unusual point where technological advances have come to the point where, as I think both Ruth and Desi have suggested, we are actually seeing the rebuilding of many of the systems and structures which we've used over time. And the geopolitical factors are coming in many cases to accelerate. We mentioned path dependence in the morning. One aspect, particularly about money and finance, is that convenience and path dependence are important. In other words, as long as we have something that is easy and works well, generally speaking, there isn't that much incentive to move beyond. We're seeing this particular combination of technological changes and geopolitical changes, which is arguably, one, enabling a change, but two, incentivizing a change. And I think when we look at this question of money and payment, what are we seeing from the standpoint of jurisdictions around the world? And like Ruth, I divide this really into the context of retail and wholesale. And if we look at what is interesting to see at the retail level, we are now seeing active competition between a variety of different sorts of processes and strategies. And we haven't seen this sort of active competition between different systems and different strategies for an extended period of time. What are we seeing? Well, obviously, if we think about cryptocurrencies, cryptocurrencies came in, the Bitcoin white paper in 2008, Bitcoin blockchain starts in 2009. This is an active, direct challenge on the basis of technology to the way which we had operated money and payment systems over an extended period of time. Now, over the past 15 years, what we've actually found is that despite the promise of the technology, once you throw in the human involvement, many of our traditional issues around financial stability, misbehavior, fraud risks, etc., these issues have come back. And across that experiment, we've gradually built a sort of common international approach to regulating the digital assets ecosystem. And we're seeing that implemented across an increasing range of jurisdictions. The US in some ways was the last holdout of the major developed economies, and now this has changed with the Trump administration. Now, from the standpoint of retail activities, the fundamental change that this means in an increasing range of jurisdictions is that the crypto ecosystem and the traditional financial ecosystem are increasingly coming together. In other words, I'm now getting messages from NASDAQ, which are selling supervisory tools to monitor the risks of trading in crypto assets. This is integration of digital assets with traditional finance, and it's moving at an increasingly rapid rate. Something that's very interesting here is that for significant portions of the world, mainly across the developing world, but a number of developed countries, the UK also falls into this category, a larger number of people under 30 have invested in crypto than in traditional financial assets. Now, that's an interesting point, that for a significant population around the world, they have used one instead of the other, and in many cases prefer one to the other. Now, this is interesting because what it means is that as we see the intersection of traditional finance and digital assets, we're going to have to look at both in different ways. Now, from the standpoint of money and payments, we're not seeing many economies where cryptocurrencies are replacing fiat currencies. The only real exceptions to this are largely jurisdictions where the existing monetary and payment systems don't work very well, particularly on a cross-border basis, or where there are significant issues, particularly with cross-border payments as a result of capital controls or sanctions issues. If we look at the area where a lot of excitement is happening at the moment, retail central bank digital currencies. This is something that we've been discussing for a long period of time. After all, payments teams and central banks, as Desi pointed out, often don't get to have much fun. And a new technology coming out around 2009, we had lots of central bank payments teams experimenting with blockchain to see whether or not it might actually be useful. The Libra announcement by Facebook in 2020 dramatically accelerated, 2019, dramatically accelerated a number of these processes. And in particular, we see in the autumn of 2019, the announcement by China's central bank, the People's Bank of China, of its intention to bring what was then called DCEP, Digital Currency Electronic Payment System, now generally known as the ECNY, to national piloting sometime in 2020. And that, I think, really triggered a stampede of central banks around the world looking at related issues. If we look at the ECNY today, yes, there are somewhere in the neighborhood of 300 million users in the context of China. But in no way has it displaced the much more popular mobile phone-based systems of WeChat Pay and Alipay. But what it has done is it has provided a mechanism to force interoperability and also provide, if you will, a financial stability backup, a resilience system. But also from the standpoint of autonomy, it's enabled China to be very confident that its domestic monetary and payment system will be resilient both to traditional challengers as well as non-traditional challengers like cryptocurrencies. If we think about retail CBDCs, we now see a very large number of central bank projects. Many of those have slowed down a bit, particularly, I think, as some of the alternatives have accelerated. And I think the one that has probably reached the largest number of users globally is undoubtedly fast payment systems. And this is something that we now have 80 plus jurisdictions that have adopted these. And for a range, particularly of developing countries, it has fundamentally transformed retail experiences with payments, and increasingly users expect to have the same sort of experience on a cross-border basis. Now, if we think about those systems, as I think both Ruth and Desi have highlighted very well, the key point is that in many cases, particularly if we think about ASEAN and the Nexus project, these technological systems have all been implemented in a relatively short period, and often the technologies are very similar. It makes the linkage from a technological standpoint quite simple. But invariably, what everyone agrees on in all of these projects is that if you look at the split today, the technology is no longer your major barrier. You can build technologies to do pretty much what you want. About 30%, 30 to 40% of your time in any project is going to be on the tech. 60 to 70% is on legal and governance. In other words, actually making it work in practice. And I think if we look at FPS, and we look at the Nexus example in particular, one thing that made it easier is that you had a group of essentially developed markets, largely developed markets within the Southeast Asian region. These countries had been working with one another on monetary and regulatory affairs very closely since the 1997 Asian financial crisis. A lot of harmonization, a lot of trust in between these jurisdictions. And if one wants to think about the real things that you need to make FPS linkages work, it has to do with trust in the other system. That relates directly to supervisory frameworks, not only from the standpoint of making sure that the institutions involved don't fail, but also from the standpoint particularly of market integrity and AML, because you have to be able to rely on the AML systems which have been developed by the other jurisdictions. And so I think from the standpoint of technology, FPS has undoubtedly transformed retail payments. We're seeing a lot of efforts trying to link cross-border payments. I think some jurisdictions where these sorts of relationships are closer are going to be easier. A lot of other jurisdictions are really going to be difficult because particularly both the geopolitical issues, but also aspects of regulatory standards. Finally, regulated stablecoins. And this is one where I think if we look at an increasing range of jurisdictions, we are seeing a number of examples where, of course, the US has made a very clear geopolitical statement that it sees stablecoins as a way to reinforce the usability from an ease of use standpoint of the US dollar, and also a mechanism for encouraging flows from a greater range of participants into US government debt markets, which can be seen as a win-win from the standpoint of the US geopolitical position. We're seeing a number of other jurisdictions which are now thinking about whether or not similar sorts of logics apply, but I would say most are at a relatively early stage. Now, where I want to wrap up is on the wholesale side. And from my standpoint, I very much agree with Ruth's point that this, particularly from the standpoint of central bank digital currencies, is where we are seeing the potential for a great transformation. What am I seeing around the world? I'm seeing fewer countries that want to rely on either the US dollar as a monetary instrument or the US-based payments infrastructure. Now, what I'm not seeing are a lot of countries that want to replace one monetary hegemon with another. In other words, there are very few countries that I run into that want to replace the dollar with the Chinese yuan. Why? Because the political issues are exactly the same that you see with one with any other. And as a result, what I invariably find is countries largely want to increase the use of their own currencies internationally. Now, fundamentally, many of the payment systems we deal with don't actually deal with the Forex problem. The Forex market is a very different thing from payment systems. And particularly if we think about something like Nexus or FPS, these are not dealing with Forex issues. And this is one of those areas where the potential of technological platforms, and we've seen experiments with the BIS Innovation Hub's Imbridge project. We've seen a number of experiments that are similar being developed in the BRICS context. Typo, this should be Agora instead of Aperta. And on the tokenized deposit standpoint, we're seeing a variety of experiments which are trying to address these issues. Arguably, the technological arrangements are now there to make it easier to trade currency pairs bilaterally. The geopolitics are there, but they face the economics. And the last point I'm going to make is just for those of you who aren't used to Forex markets. Most currencies, if you want to say, make a transfer from Indonesia to Nigeria, that will go Indonesian rupiah, US dollar, Nigerian naira, rather than direct rupiah to naira. Why? Because there is no liquidity in rupiah naira, and the costs of transacting directly across that pair are unattractive and prohibitive for almost every transaction. For the vast majority of currencies, regardless of your geographical locations, the dollar forms an intermediate leg because that's the currency you have the greater liquidity. So when we get to 4X, we're not just talking about technology and geopolitics, we're also talking about market liquidity and how can we actually, through technology or regulatory arrangements, enhance, make it easier to do those cross-currency transactions. And that's, in many ways, where, from the standpoint of autonomy, the next step will lie. Thank you.
Thank you. Thank you very much for those three very interesting presentations. I'm sure the audience have many questions, so let me open the floor. The ladies, the professor, please. The ladies over there. You, please. Can you introduce?
Question. Thank you. About something that I haven't actually heard in any of your speeches, and that was what framework do you think should be or is in place to monitor climate impact of technological advances? If we look at DLT systems, of course, our chair began with the DLT experiments, not thinking POX, but even if we look at permissioned or private DLT systems based on RAFT4 or BFT consensus mechanisms, the energy usage of that has been estimated to be about 10 to the power of 4 times more than a simple ledger system. So that is just looking at energy, not looking at water, which is also huge usage for DLT systems. So how do you draw and how do you balance technological advancements that are really necessary with climate impact, where we also have a lot of goals to achieve?
Thank you very much. Patrick Kanajan again from the University of Frankfurt. I have two questions. One to Ruth and Douglas, which is, there is an assumption that stable coins are going to be good for the dollar. Do you really think that's the case, or are we overlooking what the consequences of a broader use of the dollar might be? Secondly, for Douglas, liquidity. How do you replace the liquidity of the dollar? Who is going to give you the central bank swaps that the Fed basically uses to underlie the use of the dollar? Thank you.
Third question over there, please.
Hi, Konrad Borowicz, Tilburg University. My question is on your views on the relative utility of bilateral versus multilateral interlinking. Okay, so Nexus is a multilateral scheme. All of the 80 plus, in the future 100 plus systems can join in, but there's examples of bilateral systems like the Singapore-Thailand link, for example, that have proven to be quite successful. There's trade-offs, obviously, in terms of governance, who gets to decide, who gets to make the rules, but also in terms of issues around legal reconciliation, right? So I was wondering what your views on the relative utility of the two systems are.
So,
hi, can I go? Or, yeah. Christian Chamorro Cortland from Western Sydney University. So I had a question, well, two questions. So it's more for Desislava. So doing my own research in this area on fast payment systems, I tried to get access to the rule books for Nexus, for example, and Enbridge, to see what's in there. And I found that they're not publicly available, even though I contacted the BIS Innovation Hub. So I'm just wondering, is this something that eventually will become public, or is it just because it's in the experimental phase, it hasn't been made public yet? Because to me, it's just interesting that, okay. The second question, how will systems like Nexus deal with losses, for example, if, let's say that one bank is, or somebody's making a transfer from one country to another, and the payee bank credits the payee's account in one country, but the payor bank becomes insolvent before they credit the payee's account. So is there going to be something in the rule books that explain how losses will be allocated? Will there be some sort of default fund or a CCP, or what's, how's that going to be dealt with? Thank you.
We have 12 minutes. Who wants to start to reply?
I'm happy to start. Very good questions. I think on the climate piece, this is in fact critical and comes to the consensus innovation. I think the consensus mechanism for me was always the most critical piece, often overlooked. There are other ways of doing it more efficiently. I think we're not at the end of that journey, so I can't give you the answer to your direct question, but I would look at innovation and consensus mechanisms, particularly as it pertains to decentralized networks that are really decentralized, with more participation of nodes and maybe eligibility criteria that are slightly more broadly, because we've seen a lot of DLT implementations that are quite centralized where you don't even need consensus. I remember Professor Mikali presenting Algorand years ago, which was already in a way more efficient than Bitcoin for sure, but I do think that that merits its own research project in more detail. On the stablecoin piece, Patrick, I can't give you again all the answers, but it is very much clearly linked to the size of the economy. And that is, of course, why the US dollar has that prominence. And the question is, I mean, for many years we talked about, kind of a multi-currency baskets of doing something together across different markets with the euro, Swiss franc, sterling, etc. I think it has to be relooked at, because at the moment there's no viable competitor unless it's the yuan, the Chinese currency. But of course, that would only be a regional Silk Road type of dimension. It wouldn't be a global one. And I leave the other questions to the others.
Let me add something. It's interesting that no one has referred to the euro as an international rule. I want just to remind to the public that the euro is the second most important currency around the world. Just so, numbers are important sometimes.
I actually think that's an important point. And there is, and it's actually my next slide, which I'm not going to talk about, but there is the argument about if one wants to internationalize a currency, there are a number of steps which one could think about taking. And if one was going to do it, it's probably an opportune time to do it. Certainly you have others, China, India, etc., that are looking at this as an opportune time to try to internationalize currencies. From the liquidity standpoint, really the key is transactions. We saw in the context of ASEAN in 1997, it made no sense at all to do, say, rupiah Thai baht transactions. It was just simpler, quicker, cheaper to use the dollar leg. Over time, and this is a good 25 plus years now to make this happen, building platforms and enhancing cross-border transactions means that now there is a demand for people who actually want to do Indonesia to Thailand transactions. You then provide a platform that makes it possible to do so, and that makes sense. And there are a lot of this logic actually applied to the original Euro project as well. It's a different context. We are seeing a number of experiments around gold in a number of jurisdictions as a potential intermediate asset, which historically would be quite interesting to see because it does have a long history. Now, from the standpoint of US dollar, I think the key point here is there are two ways to look at it. One side is to say this is great for the US dollar. The other is to say that stable coins and other sorts of instruments provide mechanisms to enable greater competition amongst others. I don't think we have an answer to this yet. I think this is one of those things that we're going to see play out over the next 5 to 10 years, and it's an open question. I think from the standpoint of this point on bilateral versus multilateral, this is something where some countries, most of their remittances are single corridors, and that then makes more sense. Why deal with the time and energy if basically you have a corridor between Nepal and India, where basically all of your remittances are going via that corridor, and we find that that makes a huge difference. Last quick point from the standpoint of climate impact of payments, I actually think where we're seeing by far the bigger issue right now is in the context of AI and data processing, where we are seeing very dramatic increases in real energy usage in a number of jurisdictions. And this then means that from the standpoint of some of those issues of competitiveness, things like energy costs and energy efficiency are central to both autonomy and competitiveness. If you're trying to pursue an AI and data future, you need energy systems that are more efficient than your competitors. And for me, this is already one of our key geopolitical dimensions, is around energy, and energy actually underpins almost everything else.
Yes, so the rule book actually for Nexus, as I mentioned, that will be developed by the Nexus payment scheme entity. So whether or not they will publish that, I don't know. That would be up to them. In the other project, we do these projects in collaboration with central banks. So we coordinate and consult with them to what extent and what information they wish to make public or not. So for the time being, it hasn't indeed been made public. Just a few additional points on some of the questions. So I think also just looking at purely mathematically, right? Indeed, bilateral linking is perhaps easier because it's just one other counterparty, but that is if that reflects your economic interest. If you actually want to have multiple bilateral because your trade and economic relations are much broader, you can imagine that creates, you have to repeat that action and negotiation and harmonization with each of these different payment systems and jurisdictions. And of course, they are not aligned between themselves. So at the end of the day, this becomes a very difficult and costly process. And this is where Nexus brings a lot of benefit, because there is a level of reconciliation. And once you connect only once, then you get access to all of the payment systems which are on the platform and participating. How it manages potential credit risk, I think that was your other question. The Nexus payments are processed sequentially through the IPS in the centers, the IPS in the senders and the IPS in the recipient country. So in essence, the platform acts as a coordinator of two separate payments. So the settlement finality is dealt with and any disputes resolved in exactly the same way as they would be under the national payment system. So credit risk is not increased by participating and doing a cross-border payment on the platform. I'll just mention that what is very interesting is that in Agora, which is the unified ledger solution for a cross-border payment system, significant efficiencies we already are seeing from the experimentation are being gained because the process there is not through sequential execution of the different actions of the payment chain, but what we call atomically, which does not mean everything happens at once, but it means that because of the programmability of the platform and the tokenized assets which are used for the settlement, it allows for all of the actions to be set up, to be done once, but to then be executed all at one time. And of course, they won't be executed and the smart contract won't be applied if any of those individual actions fail. I hope I managed to explain that. It's quite in a not so technical way. And that obviously creates much more beneficial and a lot of efficiency gains and cost gains relative to the process for Nexus. But of course, there are other policy and political considerations when we start talking about a common platform, which is not linking national systems, right? It's not a bridge. Participants actually participate directly on that platform, not to national instant payment providers. But as I said, that's the topic of another very interesting, but another conversation.
So we have 2 minutes, so I can get one more question, and please.
Good afternoon. My name is Inga Reina. I'm a judge at the General Court of the European Union. I may be going with my question outside the scope of this conference, and I may a bit trivialize what I'm trying to say. So for the shortage of time, please understand that I'm exaggerating a little bit. But it was very interesting to hear the debate about the what and all the technological developments. But I'm a judge. And so far, I have not heard the debate about the availability of remedies and the dispute settlement mechanisms. And in the context of what you have just mentioned, that euro is the second most popular reference currency for the transactions, that really flags an important difference between the US dollar and euro. The US dollar involves only the US authorities, while euro as a common currency over the 27 member states and the complexity of a euro regulation and the role of national authorities brings a totally different perspective on any potential legal remedies and dispute settlements. And I would simply draw your attention to the importance of this debate because so far, my discussions also with national authorities and national judiciaries confirms the complexity. Of course, this is an important subject, but the availability and clear identifiability of legal remedies that are capable of quickly giving the result is, I think, is a key factor to this entire debate. And that provide part of the explanation why maybe some of the solutions are slow of being adopted at the national level, because if private actors know, for example, if we speak about cyber risks, that there is no quick enforceability, because there are no clearly identifiable legal remedies that would give a result within hours and days when the result is needed, then it may explain maybe the reason why some of the solutions are not given the immediate effect. But maybe this debate is premature. Maybe that will be taken place later at the conference, but I think that would be very interesting to hear your views. Thank you.
Yeah, so I think very important point. If we think about the euro as a European currency for the single market, this is why it took us so long to standardize the rulebook. So of course, the SEPA rulebook was widely published, to standardize the consumer protection legislation with the remedies embedded, and also which remedies are available to businesses, and to ensure that every payment provider, every bank is acting in the same way, as well as the settlement finality with the underpinning directive, the TIB settlement system, and the national clearing system and the ways they operate. So this was a very long journey from 2003 to the first launch in 2008 to only now, where we moved everything to SEPA Instant with the right infrastructure and legal systems that underpin it. I think the only difference is when we think about the discussion around the dollar, the euro is not necessarily widely used in cross-border international transactions, right? So this is a single currency for the single market. The US dollar is used as the currency of choice in most trade contracts, if not all. And funnily enough, English law is used in 80% of global trade contracts. So if we think about the concentration of law and currency choice, which is due to the liquidity and the size of the economy, this requires thinking and a long-term plan to see how the euro could take a portion of that. And I think this is where then the cross-border remedial question around protection of businesses and users for use of currency in a cross-border settlement context would come in. And I think we're not there yet. And what everybody's shying away from is actually truly harmonizing legal provisions across borders. We did it in Europe because it's a single market, even though it has obviously still a lot of diversity, but we did manage it for the euro currency payments, but we are far away from an international cross-border perspective still.
So we are at the end of this panel. Let me please join me with a round of applause to our panelists, to Ruth, to Desi, and to David. Well done. Well done. Let me make an add. Since you guys are so interested in the role of the euro and on international payments, please give a look at the international role of the euro report that ECB publish every year. You will find many interesting information, like, for example, that 40% of the trade around the world is invoiced in euro. So we are not so bad. Thank you.